Welcome to Countouts. In this lesson, we're going to be looking at expenses. We're going to explain what it is, go through some examples of what are expenses, and how to account for expenses when dealing with entries with regard to debits and credits. So what are expenses? Well, expenses are decreases in economic benefits during the accounting period in the form of outflows or depletions of assets or incurring liabilities that result in decreases in equity other than those relating to distributions to equity participants. And this is the definition from the Conceptual Framework for Financial Reporting. Expenses incurred are recorded in the income statement or the statement of comprehensive income. So when dealing with financial statements with regard to expenses, you will find them in the income statement or the statement of comprehensive income. Expenses decrease the profit of the business and results in a decrease in the equity. Remember, for you to arrive at the profit for the period, you take all the income that you have earned minus the expenses that you have incurred to arrive at the profit. So for every expense that you have, there is a decrease in the profit and a decrease in equity because profits move to equity. And that's what this statement says. Expenses increase on the debit side and decrease on the credit side. So whenever you have expenses and you have to account for it, you have to remember that it increases on the debit side and decreases on the credit side. And we'll show you now how that looks. Prepaid expenses is an asset that is recorded in the balance sheet or the statement of financial position. And why we bring prepaid expenses here? Well, because it should not be confused with expenses. Prepaid expenses is not an expense until that expense is incurred, and it is recorded in the balance sheet or the statement of financial position and not in the income statement or the statement of comprehensive income. An expense is recognized when it is incurred, even if cash has not been paid. So whenever you've incurred an expense, you have to recognize it even if cash has not been paid for that expense as yet. What are some examples of expenses? Well, here they are. You've got cost of sales or purchases. You've got stationery, loss on disposal of asset, discount allowed, telephone, salaries and wages, rent expense, interest expense, bad debts, and insurance. Now, these expenses that are listed here are not exhaustive. There are more expenses than this. We're just showing a few examples. And this is how it's accounted for. Expenses increase on the debit side, and as you can see, the debit side is a plus, and decreases on the credit side. So whenever you have an expense, let's say rent expense for instance, and you're doing a general ledger for rent expense, you will put the increase in rent expenses on the debit side, and that is what we are alluding to earlier on. So when do you recognize an expense? Well, here we go. Expenses are recognized when a decrease in future economic benefits related to a decrease in an asset or an increase of a liability has arisen that can be measured reliably. That is how you recognize expenses. Again, this is from the Conceptual Framework for Financial Reporting. I hope it has made sense. You can check out our other lesson on income and be able to differentiate between the two. If you have gained value from this lesson, consider subscribing to our channel, like this video, and share it to those you think it might help. Till next time, cheers.